Welcome to the topic on understanding goods and services tax (GST). By the end of this module, you will be able to explain goods and services tax, identify who is supposed to pay GST, list the types of GST, outline how to apply for GST. Let's begin with what is goods and services tax. GST, or Goods and Services Tax, is a unified tax system in India that has replaced multiple indirect taxes such as sales tax and VAT with a single tax. It avoids double taxation and helps the economy grow. It applies to both goods and services. Prior to the implementation of GST in 2017, India had a complex and multi-layered indirect tax system. Here is an overview of how taxes were. The central government taxes were excise duty, levied on the manufacture of goods within the country. Customs duty, charged on import and export of goods. Central sales tax, CST, imposed on the interstate sale of goods. Service tax, tax payable to services provided by the provider. The state government taxes were value-added tax, VAT, levied on the sale of goods within the state, varying from state to state. Octroi, local tax levied by some municipalities on goods entering the city limits. Entry tax, tax on the entry of goods into a state from another state. Luxury tax, placed on specific luxury goods. Entertainment tax, charged on entertainment services like movies and events. Let's look at the chaos prior to GST. Cascading effect. Taxes were levied at multiple stages, leading to a tax-on-tax phenomenon, inflating the final cost of goods and services. Compliance burden. Businesses needed to comply with various tax regulations and filing procedures, making it complex and time-consuming. Interstate trade barriers. Different taxes across states hindered the smooth flow of goods and services. Let's look at an example of a mobile phone manufacturer and understand his journey dealing with taxation pre-GST. Procurement of raw materials. Production stage. Interstate sale. Final sale to consumer. Procurement of raw materials. The manufacturer would pay excise duty on the purchase of components like the processor, screen, and battery. Additionally, there would be VAT charged by the state government on these inputs. Production stage. During the manufacturing process, again excise duty would be applicable on the finished mobile phone. Interstate sale. Before the introduction of GST, Central Sales Tax (CST) was levied on interstate sales of goods. It applied when a sale occurred between states, example, a manufacturer in Maharashtra selling to a retailer in Karnataka. CST was non-creditable, meaning businesses could not claim it as an input credit against their output tax liability, unlike VAT or GST. This increased the overall cost of the product. Final sale to consumer. The retailer would charge VAT from the consumer during the final sale. So, which were the taxes that got removed after GST? Central government taxes. Excise duty. Additional excise duty. Special additional duty of customs, SAD. Central sales tax, CST. State government taxes. Value added tax, VAT. Octroi and entry tax. Luxury tax. Entertainment tax and amusement tax. Taxes on advertisements. Purchase tax. State surcharges and cesses related to goods and services. It's important to note that not all taxes were eliminated. Some specific taxes like customs duty on international trade and taxes related to petroleum products and alcohol continued to remain separate from the GST framework. What are the benefits of goods and service tax? One tax, one nation. It combined many different taxes into a single tax across the country, making things simpler. Imagine having to pay different taxes when you buy something in one state versus another, GST fixed that. No tax on tax. Earlier, there was a tax on tax, which made things expensive. GST stopped this, so prices of many goods and services could come down. Easier for businesses. Simple online process. Everything from registering for GST to filing returns is online, saving time and effort. Fewer rules. Businesses don't have to follow many different tax rules anymore, just one GST rule. Can claim tax paid. If a business pays tax when buying materials, they can often get that money back when they sell their product or service. This helps reduce their overall tax. Easier to sell across states. Businesses can now sell their products anywhere in India without dealing with different state taxes. This makes it easier to grow their business. Helps small businesses. Small businesses with a certain level of income can choose to pay a lower, fixed tax under a special scheme, reducing their burden. Better for the economy. More tax collection. Because it's simpler and easier to comply, more businesses are paying taxes, which helps the government earn more. Efficient movement of goods. Trucks and goods can move faster between states without lots of checks and paperwork, saving time and money. Attracts investment. A simpler tax system makes India a more attractive place for businesses to invest money. Good for consumers. Potentially lower prices. Because the tax on tax is gone, some goods and services might become cheaper. More transparency. You can see clearly how much tax you are paying on what you buy. There are three main components of the Goods and Services Tax, GST, in India. Central Goods and Services Tax. State Goods and Services Tax. Integrated Goods and Services Tax. Central Goods and Services Tax. It is levied by the central government on the supply of goods and services within a state, intra-state transactions. Collected along with SGST for intra-state transactions. The rate of CGST is usually equal to the SGST rate for a particular good or service, making the combined rate equivalent to the IGST rate. State Goods and Services Tax. It is levied by individual state governments on the supply of goods and services within their respective boundaries, intra-state transactions. Collected along with CGST for intra-state transactions. The rate of SGST is fixed by the GST Council and is uniform across states for a particular good or service. It is equal to the CGST rate for that item. Integrated Goods and Services Tax. Levied by the central government on interstate supplies of goods and services between states. Applies to both the movement of goods and services across state borders as well as imports into India. The rate of IGST is typically the same as the combined rate of CGST and SGST applicable to the specific good or service. What is CGST? In simple terms, it's the portion of the Goods and Services Tax GST that goes to the central government in India when a sale of goods or services happens within the same state. Think of it like this: when GST is collected, it's often split between the central government and the state government. CGST is the central government's share of that tax. Let's understand it better with an example. A furniture manufacturer in Maharashtra sells a sofa set to a retailer within the same state. Both CGST and SGST will be applicable on the sale, with both CGST and SGST rates likely to be the same, for instance, 9% each. The total tax paid will be the sum of CGST and SGST. 9% plus 9% equals 18% of the total sale value. SGST, State Goods and Services Tax, is a component of the Goods and Services Tax (GST) system in India. It is levied by state governments and is a tax collected by each state government on the supply of goods and services that takes place within the boundaries of that state. SGST is levied on interstate transactions. SGST only applies when both the supplier and recipient of the goods or services are located within the same state. as GST is a means of revenue for the states. As GST forms a significant source of revenue for state governments. It is a partner to CGST. For interstate transactions, SGST is always paired with a corresponding amount of CGST, Central Goods and Services Tax. The combined rate of SGST and CGST is equivalent to the IGST rate on a good or service. Here is an illustrative example. Let's assume the value of the mobile phone is 10,000 rupees. To calculate the interstate sale, IGST, GST rate is equal to 18%. IGST payable is equal to 10,000 rupees into 18% is equal to 1,800 rupees. Intra-state sale, CGST plus SGST. GST rate, CGST plus SGST, is equal to 18%, assuming the state where the sale happens has a 9% SGST rate. CGST payable is equal to 10,000 rupees into 9% is equal to 900 rupees. SGST payable is equal to 10,000 rupees into 9% is equal to 900 rupees. Total GST payable, CGST plus SGST, is equal to 900 rupees plus 900 rupees is equal to 1,800 rupees. 10,000 rupees plus 1,800 is equal to 11,800 rupees. It's important to remember that this is a simplified example, and the actual tax liability may vary depending on various factors specific to the manufacturing and sale process. The manufacturer pays either IGST, interstate, or CGST plus SGST, intrastate, depending on the destination of the sale. The total GST amount remains the same, 1,800 rupees, in both scenarios due to the input tax credit mechanism. This mechanism allows the manufacturer to claim credit for the GST paid on raw materials used to make the phone, effectively reducing the final tax liability. What is Input Tax Credit, ITC? ITC is a critical mechanism under the GST system that allows businesses to claim credit for the GST they have already paid on inputs, raw materials, services used to manufacture or supply their own goods or services. How does it work? Paying tax when buying raw materials. Charging tax when selling finished goods or services. Claiming input tax credit, ITC. Paying tax when buying raw materials. When a business purchases raw materials or services for its operations, it pays GST to the supplier. Charging tax when selling finished goods or services. When that business sells its own finished goods or services, it charges GST to the buyer. Claiming input tax credit, ITC. The business can then claim the GST it has already paid on purchases, inputs, as an input tax credit, ITC. This allows them to reduce the final amount of GST payable when selling their goods. Now let's look at who applies for GST. Not everyone in India needs to apply for GST. Whether you need to register for GST depends on various factors like the nature and scale of your business activities. So, who needs to register for GST? Businesses with a turnover exceeding 20 lakh rupees in a year. This is the threshold limit set by the government. If your business crosses this limit in a given financial year or expects to cross it in the current year, you must register for GST. Certain specific categories of businesses. Even below the 40 lakh rupees threshold, some businesses are mandatorily required to register for GST, including suppliers making interstate supplies. This applies even if the annual turnover is below the threshold. E-commerce businesses supplying goods or services through an e-commerce aggregator. Casual taxable persons. Individuals or businesses registered under specific provisions like supplying goods through exhibitions or events. Agents of a supplier. So now, who does not need to register for GST? Individuals or businesses with a turnover below the 20 lakh rupees threshold and not falling under any of the mandatory registration categories. Special category states. In some special category states like Arunachal Pradesh, Manipur, Meghalaya, Mizoram, Nagaland, Puducherry, Sikkim, Telangana, and Tripura. The threshold for registration is still 20 lakh rupees for the supply of goods and 10 lakh rupees for the supply of services. So, what are the documents required for GST registration? You need to gather the below documents: PAN card of your business entity, proprietorship, partnership, etc. Aadhaar card of the proprietor or authorized signatory. Proof of business address. Latest utility bill, rent agreement, etc. Bank account details. Account number, IFSC code, etc. Mobile number and email ID is necessary. Digital signature certificate, DSC. Not mandatory, but recommended for online signing. While applying for the GST, choose the appropriate registration type. The registration type depends on your business structure. Options include individual proprietorship, partnership firm, limited liability partnership, LLP, company. So what is the process to apply for GST? GST registration is completely free when done via the official GST portal. The first step is go to the GST portal, www.gst.gov.in. Click on New Registration and select the relevant option based on your chosen business type. Next, fill out the online application form, enter all required details, and upload scanned copies of your documents. Submit the form. Next, verify your registration. Within 3 working days, you'll receive a Provisional Registration Certificate, PRC, via email. Final GST Registration Certificate or GSTIN is issued within 7 working days after document verification. Some important points to consider after applying for GST are: once registered, you'll need to file GST returns regularly. The specific frequency and format depend on your turnover. You'll be responsible for charging and collecting GST from your customers for sales exceeding 2.5 lakh rupees and depositing it with the government. You can claim input tax credit, ITC, on the GST paid on purchases related to your business. This helps reduce the final tax liability. Thank you.